Welcome, week two, April 29th, Net Lease Industry Show. Thanks again for everyone can join us. Finally figure out the tech issues. I apologize for last week. We hit the live stream button a little bit late. So some people who are tuning in, I apologize for that, but I appreciate you tuning in. Send this out to our list. As everyone knows, we specialize in the net lease industry market, essential net lease. So a lot of investors that um, are from rental markets, other commercial assets, find us and we find solutions that make sense in the essential net lease industry. So last week we started with the intro call, kind of giving a baseline to the show. So we're going to kind of go into, let me grab up my show notes. So this week we're going to cover the cap rate numbers for, we usually follow about 170 something tenants, but there's about 25 that are actively traded, and we kind of keep an eye on those. Those are the tenants that are most trafficked back and forth to buyer to seller. So we kind of keep an eye on that, which gives us a good pulse of the market of retail, which mainly in the essential services space. Investors like that as some good data as they're planning on different buying and selling strategies, and also 1031s that we're kind of planning in place. We're also going to take a look at the 10-year Treasury. It gives us kind of a sentiment of where the market is going, not kind of critical because, again, we're dealing with essential services, but it also does tie into the retail side because that is also getting indicators of where we're at with the market. As everyone knows, we're also dealing with trade negotiations with several countries, and market's been kind of reacting to that. So we kind of want to give people a look on what it means, what they kind of plan on doing for the future, so they kind of know as much information as possible. And then we got about 5 frequently asked questions that we've been getting. We have kind of like a large list, and we just say, well, let's pick 5 that are relevant for the week. So we're going to talk about those, and then finalize that with a little short educational piece where we're talking about mistakes that investors make according to lease agreements. So we'll kind of go into that. So to start things off, let's get a quick glance of this week's cap rates. And if you can't see the screen too well, just shoot us an email, and then we'll send it over a copy. And again, like I said, we cover, just about 25 tenants that covers automotive, financial services, big box stores, dollar stores, quick service restaurants, casual dining, fast casual. So things of that nature. It kind of covers the majority of the market space. And again, for any particular tenant that you want any deep dive data, we can also send you those as well. Just shoot us an email on any of the newsletters that we send out each week. But in general, we're still seeing a consistency across the board. Cap rates has still been hovering around that 5.8 to 5.79 range. And these are for 10-year plus leases. So obviously, some people own or want to explore stuff that are less than 8 years, but 95+% of our buyers and people that trade to buy is looking for 10-year plus. So that's why we include that data, and then we also compare that to the Treasury. So as we add more data, we can kind of see some fluctuations, and it does kind of paint us a picture, but for the most part, it's been kind of remaining strong. And what we were just talking about off camera was the really corporate investment grade tenants that have high demand, and those been consistent across the board. So that's why we want to look at indicators, but at the same time, it is real estate, and then we look at, of course, indicators that would affect the overall business, and of course the demand side. So our buyers, depending if you're using financing and cash, we kind of look at where we at are from negotiation positions. Most of the investors that we deal with are heavily leveraged. So they're doing either 50% or more down payments, or they're going in all cash from like a 1031 exchange. And that from now, that is giving those buyers a unique advantage when it comes to negotiating due diligence terms and pricing and closing terms of that sort. And that's what we've been noticing. We've been sending a lot of referrals over to our mortgage lenders and getting quotes and kind of seeing what opportunities out there. Rates are still high, so it's again it favors people that are coming in heavily leveraged if you want a kind of decent spread for your ROI. But people are still doing those deals. But as far as negotiation leverage, we've been noticing the investors that are coming in with a little bit heavier cash or all cash. We've been getting some, decent negotiation options for some of the deals that we've been, closing on. So just kind of keep that in mind, and again, we can talk about your specific situation, and then see exactly what could be a good game plan for you, and that typically involves dealing with our mortgage lender, or if you have one in place, and us running through the numbers and just seeing what's out there in the market in your particular situation. So yeah, numbers been consistent. Like we're saying, 581 to 579 in that range. And again, the tradable assets that we've been dealing with is still, very frequently trafficked quick service restaurants like the McDonald's, Chick-fil-A's of the world, as well as the same, Dollar Generals, Walgreens, 7-Elevens. So those has been traded because of the investment grade quality, the business plan behind it, and as we've been seeing now in the markets, it's been volatile in the financial markets. So people are shifting into real estate with good um, uh, characteristics of the property, locations, places like Florida, Texas, Arizona, South North Carolina, and kind of sticking to very strong markets with good characteristics there. Okay, so next, let's kind of go over, and we just covered a 10-year. I have, and I'll leave that presentation a little bit later. And if anyone's on the stream that want to chime in to ask anything, jump in at any time. I kind of had a list of items I was kind of go over. Um, and as we do this, make sure that you look out for our calls. Quinn's been frequently following up with a lot of our clients and past customers on the phone to see what kind of their plans and getting a little bit of pulse and feedback of what's going on in the market and what their sentiment is. Because we wanted to kind of really put a lot of this information up front with the data and giving you as much information as possible. So you kind of are clear-eyed on your vision, because a lot of times we have investors that we talked to years ago, and they say, yes, I'm going to be selling my rental portfolio, I'm going to sell my condos, I'm going to sell this apartment building, I'm going to get in a net lease. Why? Because of triple net lease structure. It's going to be a good corporate tenant, it's going to be in a good location, and I get to live a certain lifestyle. And then all of the stuff with, of course, the new presidency, the movements with trade negotiation between different countries, the markets moving, and a lot of media going out in different directions depending on what side of the fence you are. So we want to kind of make sure that this data is out there and we go over it together, along with the intrinsical values of net lease and why is it important. Because it's not just I'm gonna just be interested in that lease, and then if I hear something, I'm gonna now totally move off of it. Most investors go into this because of the structure of the lease, the essential necessity of the tenant, the location, and all of the reasons why people will shop, eat, and patron these businesses each and every day. So we're looking at the business plan, and does it make sense? And does the tenant have the ability to pay rent? So we always look at that as our main jux, so we can be able to kind of funnel people in a proper direction and see if it ultimately makes sense for them. Is net lease the highest return on investment? No, there's other asset classes, multifamily, industrial. There's a whole bunch of Airbnb that you can get a higher return on investment. So it really has to fit into your overall strategy. And most of the time, this is not just the only asset that they hold on to. So we work with a lot of multifamily investors, a lot of industrial investors, a lot of stock investors, a lot of crypto investors, and they're just adding this as a tool in their toolbox to add on, or they just could be a complete replacement of the assets that they're already in. A lot of clients that they've worked for 20 something years in owning franchises, owning businesses, doing other ventures, and they said, I love it. I would love to buy me a nice McDonald's, triple net lease, and I want to travel with the family. And that's kind of ultimately the attraction point of when I first got into this industry with my mentor. He was a landlord owner of multi singles and multi-families, and he owned that Walgreens pharmacy. And he says, I'm going to eventually sell off parts of the portfolio over time. He'd make his money and 1031 into different assorted net lease properties with a good mix of the portfolio. And a lot of our clients resonate with that because it produces a certain type of lifestyle when you kind of go down that route. So that's where the market's at. That's where the 10 years, the Treasury. Oh yeah, let's talk about Treasury. So when I did this about, I would say, an hour and a half ago. Right now we're at 4.168 for the 10 year. And so that kind of dropped about 48 since I last drafted my last notes. So again, the average cap rate exceeds that. Obviously, it has a higher risk than the 10-year Treasury, but it kind of shows you just where we're at in the marketplace. And I like to always direct people to look at it from the long-term play. Obviously, we want to look at all economic measures, but the general basis of net lease investors is 10-year, 15 plus year contractual agreements with a essential need tenant and a good location, good piece of real estate with an A and B plan, options, rent bumps. And if you have those elements, you're in a good position, and tax benefits. So there's many attributes that we like about the net lease industry, and hopefully that's something people to consider to add to their portfolio. So that covers that, and from there, Quinn, do you want to add on anything before I move on to the next segment?
Well, I was just going to chime in, if you don't mind. Could you just talk about the tariffs and how they are affecting some of the net lease industry? Because I talked to some investors earlier today, and that was their major concerns there. So I was going to tell them I would bring that up with you on the call when I speak with you later today.
Yeah, so the tariff, as everyone's kind of seeing where it has some effect on the market, but again, kind of hovering about what is the long-term game plan. So tariffs is going to affect because we do a lot of imports from different countries, especially our largest is China, where a lot of the products coming in, even from like, you go to an automotive store, some of the products are coming from Canada or Mexico, or some of the products I get from, windshield wipers are coming from China and other India and Pakistan and different parts of the world. So that will affect overall, either the company is going to increase prices that passes directly onto the consumer, and they will also be adjusting business models, of course, of that. And of course, we're always focusing on the long term and dealing with essential need tenants. So I also have a lot of conversations about this particular topic with investors that are doing 1031s, and they're going to be moving a significant amount of money over to some property. So they want to make sure, like, is this really going to affect my tenant's ability to pay rent? And of course, there's always going to be some adjustments. So we've been talking about, which for the United States is the services side. So not only that they provide products that they're reselling to tenants, but they're also part of their business model is services. May not be particular direct to this case, but I'll just throw out for an example. Um, Aspen Dental. It's a corporate um, service business that they provide dentistry to people, which obviously they have some of the items that they're utilizing to service their clients, but for the most part, it's all service based. The food, of course, some of it are coming from different parts. Some of them have advanced supply chains, not just globally, but locally, like from different farms and things of that sort. So we always want to kind of strip down and see the business model of the tenant, how they're making their money. Is it solely dependent on retail trade from outside the country? So that's why we don't really talk much about discretionary retail tenants, like places that are, fully getting all of their inventory that they're reselling over to the consumer. So if they have a good mix of supply chain that are not only local and national to or semi-national to other neighboring countries that the tariffs are relative, that it makes sense for their profit margin and they can still service their customers and not completely decrease the demand, that's where the direction I would head. So always looking at it from a case by case basis, but at the end of the day, we're looking at long contractual lease agreements with corporate, very large corporate or investment grade tenants that they'll be able to withstand this as we kind of see where we kind of heading at. Obviously, it's still early to tell. So for us to make very decision to say, no, I'm not going to do this, or we're not going to go in this direction, is kind of defeating the purpose. We got to look at it from a long-term perspective of, is this business model serving the needs of the customers in its local and national marketplace? So that's a good question. And like I said, that's a topic that we're probably going to be revisiting quite often, but we just want to make sure that we deep dive into data and just make it put out the best information we possibly can. The next thing is also is diversification. So obviously we may find attraction to specific tenant bases that makes sense as far as the cap rate, the location, but then we may be feeling somewhat vulnerable as far as like their business model and the interim. So it's always good to diversify your portfolio. I have clients that own from to seven major sectors, from automotive to dollar stores to medical office to big box and all these different type of stuff. So it's good to have a nice balanced portfolio and also including other asset classes or other streams of income. So those are also stuff just to keep in mind of where we're heading as we kind of see how this plays out. But we also want to make sure what your long-term strategy is. Find out what the elements of the net lease tenant, the location that makes perfect sense to you. Does it have a plan B? I always look at real estate first. All of the metrics from traffic count to visibility to lease structure to tenant strength to demographics. Those all play a huge part, and that will kind of take majority of off of the leaning than just what is in the news of the week. So good question there.
And just to piggyback off that, Dwayne, I know some investors are very stressed or worried when they see the tariffs and they see the stock market of their particular tenant go down. I just want to get your input on what would you recommend if they say they like Tractor Supply or Dollar General and this week their stock went down? Does that overall affect if they still want to purchase one, the overall quality of the tenant per se?
No, again, it's the same kind of last week. They were kind of talking about the major drop that we had last week, and then we also had a huge fluctuation upside. So we didn't even. So we're actually been up for the month of April. So we're going to see some fluctuations that are because again, traders are moving money all around, but we're looking at in general the business model of the tenant, the real estate, and the kind of the path long term moving forward. So once we kind of have our eye on the ball long term, because one thing I noticed is that along with trade negotiation, there's also multiple things that's happening in place for plans of deregulation, tax relief and taxes are once it's amended into Congress and codified in law and extended, that's permanent. Trade is a negotiation tool, and from my perspective, and that can be temporary. So, for example, the trade stuff can be resolved today, and then everyone can kind of go right back, and then you all of a sudden see stocks moving up and things of that nature. So we can't really make huge long-term decisions based off of what we're seeing with tariffs, because tariffs ultimately, and the view from the administration as a negotiation tool to get favorable terms for United States-based companies. But once Congress finally gets the package together that Trump has been pushing to get the tax benefits moved along, coupled with deregulation and reduction of energy prices, that's going to be a huge benefit to even offset some of the continued tariff negotiations, which could be prolonging for maybe a couple months or maybe a year or so. So we kind of look at the multiple streams, because obviously the news media is going to be hitting hard on certain segments, and we're going to see reactions from the market. But we're always going to look at it from long-term play. Is this business model of this tenant set up in a way where it can be able to pay rent? At the end of the day, we're not, you don't own the business. You are the landlord of the tenant. So you want to make sure that they have the ability to pay the rent. Obviously, you want to make it comfortable for the tenant to pay rent in the long term, where it doesn't affect your cash flow. But at the end of the day, we want to look at all the elements that it will make sense for your tenant to do well in their building and at a long term perspective. So that's a good kind of additional follow up question. So anyone else that have anything similar to that, just chime it into the chat, or once we send out the replay later on after this, just shooting any questions, and like I said, or something that we happen not to cover, we'll make sure to cover it next show. So moving on, and as we kind of continue on with questions, let's kind of go through a couple that I had in our database to cover those at least. And again, that will give us some time for people to kind of chime in if available. Take this off. So next one, and we probably have covered it, in an ancillary format as we kind of went through our discussion. So again, that was kind of talking about Detroit, and that was that was just when I checked it about an hour and a half ago, and that's also moving. So again, I'm not making long-term decision stuff, because the good thing about with net lease, we're buying into contractual long-term lease agreements with the tenant. On a different sector where fluctuations, where say rents or contracts on an annual basis, oh, I'm really hyper focused. I'm locked in with what's going on in the active market, as if like I'm a trader. So I'm constantly scanning where's the opportunities and where's the risk, and then I'm making adjustments at that standpoint. But again, we're always basing everything and prioritizing tenant quality, lease length, and location. I'm putting together a hot sheet because we usually, that's one of the frequently asked questions is, location. Where should we invest in? And it's just business friendly states and markets. And there's a handful of them. And if you couple that from the federal side of tax benefits and deregulation and energy sector, all of these markets going to benefit. But then there's always going to be states that are more prone to be more business friendly. So we want to look at those markets, and then make decisions as far as traffic counts, where in part of the town. Like here in Florida, I'm in Southwest Florida. It is a ridiculous amount of development, and you have such high demand. You have apartment buildings, shopping centers, retail strip centers popping up all over the place. The number of people moving into the area, And like those are the elements that we're going to look at, from population increases, is any major industries moving to the area, any major businesses are relocating. So those are the stuff we're going to be looking at, because we're looking at it from a longer term investment perspective. So again, treasuries, mortgage interest rates, tariffs, all these things are extremely important, but it just gives us more and more valuable data to either make adjustments of saying I'm going to jump into different sectors, or I'm going to double down and buy on this tenant, do this and do that. And also obviously it does affect financing, so that could also affect your investment strategy too, as we see kind of the demand and where Treasury then will push rates later on. I think I read a story that they're, because of that, I think rate cuts are still off the table for June. But like I said, we'll keep an eye on that if anything changes. Things are just moving so rapidly. So for us to get kind of caught up in the news of the day is not really warranted, because we're trying to look at it from a long-term play of investing in quality real estate. So that's always the key there. Next question is, are all cash buyers gaining more leverage now? So yeah, I kind of alluded to that earlier. So majority of our clients are highly leveraged with cash or all cash. We do work with a couple finance people that are kind of coming in at 35 tier, right at that bare minimum, and just seeing where the numbers are. At the end of the day, it's come down to the strategy. Our preferred mortgage lender that we deal with all the time, that's one of the first questions he's asking on the line is, how long do you plan to hold it? What's your plan for it? So then he can gives options on the different lending packages, and then we can kind of take it from there. And then once we kind of know the data, how much money you have to play with, then we can kind of check, does that make sense with the cap rates for a particular sector, a particular tenant, and and then set up along with your long-term game plan. I plan on hold it is 8 years, or I have a client where they gonna hold it, pass on to the kids. I plan on selling it in a year. So you have to kind of look at the different packages to see, if there's pay down penalties, structures, is there prepayment penalties, what's behind it, and then we can kind of leverage that to make it make sense. And then once you sell it, or you do a 1031, and you're going to cash out. So there's a lot of different things to think about. So we want to make sure that that's fully aligned with your long-term strategy and financing capital structure stack. Next, what are the early signs that a tenant might default or sell back leases? So again, it kind of go back to our first point of just taking a pulse of the market. And one thing I've talked to another client about is I use Google Alerts. So I go to a Google Alert, and what that is a tool in Google that you're able to add in different keywords. And I put in all the tenants that we deal with. I put in all of the CEOs, the key principals. I put in all of the different markets. I put in like different stuff that involves economy, taxes, regulation, global markets, stock market. So I'm getting all these emails every day, and I'm just kind of checking the pulse of what's going on in the market. And occasionally you get some stuff, oh, this location's closing. This company is, trying to reduce debt. They're restructuring stuff. Obviously, Rite Aid, Walgreens, some of I forget that dollar store that was out in California, it closed all 300 locations. So we're looking at that. And then also, who are those tenants related to that we can kind of see trickle signs of others to come. So it's really just finding out what is going on out there, so you're self-aware. And of course, every deal that we're looking at it from, does it work now? Will it work during the lease term? And what are the options if the worst case scenario? Like, just for example, during COVID-19 pandemic, there was a lot of movement, even from very strong tenants. So you want to make sure, is the lease sound? Is the location sound? Is it an essential needs tenant that stayed open during the pandemic so it can service its customers and pay rent? Does it have good language in regards to tenant default and all those type of stuff? So those are important things to look out for. So you make sure that you're in a more comfortable position, and and take it from there. And of course, we will be sending out a notification pretty soon where we're going to be breaking down some example leases. So we'll just grab a bunch of leases from some past deals and just kind of finding out, kind of like a live class of, where's the vulnerabilities. So then you kind of understand, because I've looked at so many of them, I just kind of scan it quickly. I can see all of the stuff. We utilize a very custom AI system here, where is also to point out stuff that we will have concerns with, that we want to bring up to the client, or have a conference call with his attorney, just to make sure that those points are addressed, to see if it makes sense to move forward, or something that we can address with the seller or the tenant to kind of reconcile. So those are things that on the lookout. So just kind of look out for your emails as we do a webinar on those. Is it better to buy a shorter term lease with a high cap rate or a long term lease with a lower cap rate? 95% plus of our investors we deal with are long term investors. Yeah, there's strategies to buy short term for the high cap rate. So it really comes down to your overall strategy. Just keep in mind, if you are buying short term, that you have to have in place a redevelopment or resale plan, because you can buy it. I have we had a client now who's looking at selling a short term lease with a investment grade tenant, and we had to now plan out the exit plan for the tenant, and also who's going to be the new release buyer or the new buyer. Are they going to wait to the tenant leaves the building, put a business there, or they're going to negotiate with so it's so many different stuff that you have to think about. So it really comes down to your full-time game plan. But most of the people who tend to buy in a net lease, or they come to find this industry or this niche, is the long-term lease agreement. That's what they're attracted to. So they're like a 10, 15-year lease. It has a very conservative return, a lower cap rate. So you got to keep that in mind, that that's what it comes down to. I always look at it as you want to have the success of the tenant and, of course, the success of the landlord. So you want to make sure that both parties are happy. Obviously, you as the owner, you put up a lot of money. You want as much money as you possibly can get. And that's where we come in, where we're going to try to negotiate every penny we can possibly get off of it. But we want to make sure that you're also understanding of what's the game plan when you move into this type of net investment strategy, where the cap rates are relatively conservative. So kind of keep that in mind. And finally, where are the hidden opportunities right now and in buyers? Like we was kind of heading off in the top of the show, was a lot of activity in the capital markets. It seems like there's a lot of different stuff going on, and a lot of people would wish to have more certainty so they can be able to plan exactly what to do. But the administration's angle, or what they said that their plan is to start discussions, negotiations, and then couple that with deregulation and tax policy. So I always been talking, and this is for quite a while, is the service-based essential need tenants. I just mentioned an example like dentists, auto, which of course that's been kind of in the middle, because they also have to buy product to fix car, but there's also in the service industry. Car washes are been pretty popular now. They've been very attractive cap rates, long-term lease agreements, and like here in Florida, there is quite a few of them. I have a membership to one, and it's just like you just go. It's a service, and it's like so kind of keeping that in mind, those are the opportunities. And another big opportunity is sale leasebacks. So we've been seeing a number of those pop up, and that is in relation with the opportunity. So sale leaseback is the tenant currently is operating their business in a building and operating as normal. You as the buyer come in and say, okay, I'm going to buy this real estate, and then the tenant or the business is going to lease it back from you in exchange for typically a fresh, brand new long-term lease agreement, with all the negotiation of, rental increases included. So those are opportunities right now, as there's like a mix of businesses need capital. So obviously them selling the real estate to you, they're getting cash, which usually allows the business to expand their business as well as improve the existing location that the new buyer is going to acquire. So it's kind of a win-win. You get a long-term lease agreement, the tenant gets some cash, they get to improve their property, and they also get to duplicate this process and go into other opportunities and expand their business. So we've been heavily looking at that because our clients like long-term predictable cash flow. So if you get a nice 10, 15, 20-year lease agreement, 10% rental increases every 5 years, a strong location, a strong tenant, that's a win-win. The tenant gets their capital, they get to improve that location, and then they get to go and do that again in different capacities. So those are opportunities we're seeing right now, and we want to kind of keep that aware. But obviously, same principles apply. We're reviewing the lease, making sure everything is looking clean, check the real estate, all the intrinsical values of the properties there, of access, demographics, good state to invest in, and all of those same principles apply that we're looking, even though there's different opportunities there. So anybody else have any chime in, just let me know. The next part I'd like to cover after this, and you guys hear a little bit of splashing. We're finally getting some rain. We've been dry for like the past at least like a month. And now all of a sudden here, like I don't know if everyone can hear that rain just like going crazy in the background. So I hope it doesn't affect the audio quality too much. Is it raining over your side?
Nah, not it's dry over here, so
Yeah, so I'm more north, so I would expect this not to go on for too long. So
And Dwayne, I was gonna say, if you don't mind, possibly in like the near future, can we just do a segment on sale leaseback and how that's structured? Because a
yeah,
lot
I
of
can
investors
make
that we
a video
talk
plan
to,
for that. Yeah, we
they're
got a,
kind of
a
confused
webinar.
on how that's structured, and given it's 20, if I tell them it's a 20-year sale leaseback, they don't even know how you just explained it. So if we could do like a breakdown, look at the lease, I think that would be very helpful for them in the future.
Yeah, we're gonna be going in detail in a webinar. We'll give like examples, some sold deals in that capacity, what to look out for. Because the unique thing about the sale leaseback, just to kind of jump on it just for a few seconds, is that you're getting a fresh lease. So it gives the buyer an opportunity to dig into the details of the lease agreement and negotiate. Typically, when you buy a standard net lease property, the lease is already signed. So you have to agree that you want to buy this with the terms already laid out, or you don't. So with the sale leaseback, there's an opportunity for some negotiation. Obviously, we want to make it's a negotiation, so it has to be favorable for the buyer and the tenant. But there is some opportunity there where I've in the past negotiated higher rent, I negotiated higher rental bumps, lease length, improvements to the property at closing. So there's some opportunities there for people to look at. Um, and then some of them were it's just good as in place, and they say, hey, this is perfect because they're getting a fresh at closing, a brand new, say 20-year lease agreement. So some case you will send you a deal and say it only has 13 years left on a lease, but let's say a lease back at the day of closing is fresh, brand new. So that's a good opportunity for long-term hold as well as resale value if you want to hold it for a few years and then resell it in the future. So good cut there. So my educational component, let me just go down to my notes, is why lease structures matter more than cap rates in 2025. And also, mind you, just a quick plug, which I'll talk about then at the end, is the Net Lease playbook. Just so the original was mailbox money, real estate mailbox money, but this goes way deeper. And this is for additional 10 years plus of experience of dealing with investors at all different levels, to small to very large to institutional grade clients of transactions. So I cover that from developer to the typical retail buyer. So jump in, grab on Amazon. It's only $14. It's $10 for the excuse me, the Kindle version. And I kind of go into from talking about leases, lease structures, what to look in the leases, locations, tenant quality, everything we kind of touched on. We're going pretty deep into it. And if you do buy it, just shoot me an email at dclark@americannetlease.com, and I'll put you on our email list where I'll be sending out links to when we go into deep dive. So Quinn had mentioned about the sale leaseback. That's going to be part of a series that we're going to be going into different strategies, but we're going to go like behind the wall and actually pull up a lease, and we're just going to just like look into it, because we end up having to do this with all the clients anyway. So we'll just have it recorded and then have everyone benefit from it. Because when we work with a client, we're analyzing everything, and we're in concert with your attorney, with your CPA, with your financial advisor, with the lenders. We're all locked in together, and we're going through it because we have kind of experience dealing with them. I don't just say, hey, we got this on the contract, go have at it. But we also try to look at and say, hey, did you see this? And we want to make sure that it makes sense for you, since we're representing the buyer. So obviously our interest is in your success in closing it. So we want to make sure that we look through it. And plus, all of the major 25 tenants, I've sold multiple of each and seen almost every type of lease structure. So I kind of tend to notice things and make sure that, for the most part, if there's stuff to highlight to your attorney, this of course doesn't replace your attorney, but it just at least gives you another set of eyes to make sure that okay, this makes sense for me. And then the lease tours, if it's obviously within our markets, and I've also traveled to different states where I sent out a contract for a client and they just covered our travel costs. I've went to the site, took pictures, met the phase one consultant, took videos, had a meal there, so I let you know if the food was good, and then make sure just as another helpful eyes, because some of our clients don't have the time to go to either they're selling a property, dealing with the kids and wife, whatever it is. So we're here in the support just to make sure, including is conference calls. We're going to start doing that. I talked to our lenders, attorneys, and some of our past clients that have no problem jumping on a call and just kind of giving their insight, their feedback on what's going on, and just to give you a little bit more confidence. And that's really it is, just confidence. Obviously, it's a book, but we want to make sure we give you as much tools as possible, so it make sure that once you make the decision, you feel pretty good about it. So that's why I just wanted to kind of bring up. And again, I'll put this link out there again, but you can just drop the Net Lease playbook into Amazon and it'll pop up and you can grab it. And again, we appreciate your business. So for today's educational part, we're talking about the lease structure matters. So we kind of see out there net lease, and it's kind of a convoluted term, and people automatically assume because they hear it from a friend or colleague or they've Googled it that yeah, that it's great to own a tenant or a piece of real estate with the tenant, and they pay all the bills. That's why they come to us in the first place. No one wants to leave from being a landlord of a two or three unit and then having to go babysit another tenant. So that's why you want to make sure that when you do look at it, it is an absolute triple net. There are there are offering memorandums. There's information online, and sometimes you have to look through it kind of in detail and catch it. There's a little bit of fluff in there sometimes. So you want to make sure that if it is a double net, which is not a bad thing, that you're fully aware of the pros and cons of it, and you feel comfortable moving forward with it. I have plenty of investors that bought um, net lease with double net, and they're responsible for the roof, for structure, HVAC, and they said, "No, this looks good for me." Run the numbers, still okay, and they have no problem with it. So just want to make everyone aware of that. So net lease isn't always absolute. True. So they'll use the word net lease, but you want to make sure it's actually triple net. Which the triple net is the taxes, insurance, common area charges, and all that. But there's also nuances of how those are paid as well. So you want to make sure, are you okay with those type of setups? Because there's both, and you want to make sure at least you're aware of it, and then you're not surprised if it ends up popping up later, that you have to deal with. Because we've got calls where it's really an absolute triple net, and they had like a roof warranty, or they had this, and all of a sudden they getting a call from the tenant, and they say, "Hey, you got to deal with this." And listen, I'm like, "No." Yeah, we look at it like, "No, this is true." So you got to just look at it, and then see if you're comfortable with it. But it's not as black as white as it seems. So again, tenant pays taxes, insurance, maintenance. So no capital expenditure risk to the landlord, and that includes, like I said, the roof structure, HVAC, and some tenants have certain structures where it's like that. For example, O'Reilly's Auto Parts, they usually have a parking lot or HVAC or a roof, and you got to kind of look at. I saw one where it was just the landlord was responsible for the signage, and that was it. But anything that had to do with it, they'll call on you and say you got to fix the sign. So little stuff like that, it may be worth it, and sometimes it's not worth it. So you want to make sure that's something that you're okay with. The hidden risk, as we kind of alluded to before, um, each of those, are you comfortable with that? And sometimes they have a dollar mark, which I think we're gonna cover here. I'm kind of getting ahead of myself. So what we do is, and I forgot to do it before the call, I was going to put together an audit checklist. So if anyone wants that between this stream and the replay, just shoot me an email, dclark@americannetlease.com, and just put lease audit checklist. And then if you could put in the body where you found us from, that'd be great. And I'll send you over a copy. So we have an internal document where we make sure, along with our deal flow, that we have this, and that, to make sure we're on pace, as well as our due diligence. So we're working alongside of the other consultants and the client to make sure, is this stuff covered in the lease? So then when we do the final read through, it finally makes sense. And like I said, we have our internal systems that we use, as well as I manually read through and make sure that is also covered. Another big thing is insurance and taxes. So most of the tenants pay that, but do they pay it directly, or is it a reimburse? For example, Dollar General does most of the time a reimbursement. So the landlord has to pay that tax bill upfront, and per the lease agreement, they'll get repaid back within 30 days. Some people don't like that. Some people are okay with it because it is a short-term thing. The tenant does cover that and pay for it, but again, it's in a reimbursement model. I also had cases where in the lease, it was a predetermined lease signed that we was able to actually send the bill to the tenant and then make a additional rider to the lease agreement that the tenant agreed to, that we are able to send the bill directly to them, and then they pay it directly. In many cases, well, not in many cases, in some cases they don't mind that because they have to pay it anyway, and then they just get the bill, and it just takes away one hand that has to deal with it, because they do in this particular case is agreement with the landlord to make sure that you handle your business, and in return they handle their business. So we want to make sure that both parties are on the same page. So that's why in some cases I seen we were able to send the bill directly to the tenant and they just handle it, because they want to make sure that if they're operating their business that could affect their business, that nothing comes in the way of that. Are there early termination clause, relocation clauses? Yeah, those are a huge one. And a lot of times it's nice that the whoever the listing broker, or if we're listing the property, that is on as a deal point to the client to make sure that it is something that they're okay with. Because, for example, Starbucks in some locations do have early termination. Why do they do that? They want to kind of test the location to see if it makes sense for them long term. So, for one example, we've seen and I've sold quite a few, a 10-year net lease, but then it has a early termination clause in there, which allows the tenant to give you about 12 months notice and get up out of there. And use a tenant, they'll just go like right across the street because the flow of the traffic. They say, okay, we like the morning traffic, you know, rather than the afternoon, evening traffic. And that's a business decision. But now you're stuck with a building. What do you do? So those are things that you want to make sure those are covered to see if that makes sense to you. 99% of the people do not like the early termination clause. So what I've noticed that has been a sentiment in the marketplace, because it is affecting the buyer pool. So the developers or the landlords who are renegotiating these leases have got those out of there. In return, the tenant then are more selective on the locations that they go to. But in case, obviously both sides are talking to each other, so they say, hey, how can we do business? Because the landlord doesn't want to own a building, and then the tenant leaves after a couple of years, which then leaves the landlord to have to do something with the building. And the tenant preferably want a location where they're there and they're making money. So we're trying to find a balance. Either it's the rent adjustment, or there's always different nuances when we're dealing with that. But those are stuff that we have to find out early, particularly as soon as you look at the package. Is there early termination or relocation clause in there, so we could be up out of there and just move on to a different opportunity if that ends up being the case. Is at least corporate. So corporate is a all-encompass term. Corporate is little as meaning you just have a corporation with a high net worth owner. Corporate can be a Dollar General, where it's like this massive, large company with locations all over the country that's publicly traded on the stock exchange. So we have to look at the level of corporate, and then you have franchisees, where it could be one individual franchise owner, or it can be a company where it has 1,000. So that word kind of gets used a lot. So we go deeper to find out what is the actual entity and what is the financial guarantee of the lease. That's really at the end of the day. It could be a franchisee, which those are very good opportunities. We want to make sure, does this tenant have the ability to be successful at this location and pay you rent every month for the entirety of the lease? That's always the encompassing story. And it could be 1 or 2 unit franchisee. We don't want to be afraid of those either. It could be at the most rock solid, stellar location, and their management they on top of their business. So we just want to make sure that we look at not only the lease agreement, but of course, all encompassing everything to make sure that, is this tenant set up for success to pay your rent? So it kind of talked about a few examples, of course, Starbucks and the Dollar General. And like I said, this is just many of many. And again, most of the time I see at Burger King, they're straight triple net. They pay directly, but then you'll find out there is nuances in everything. So I just put like just a little example of, in this case, in the lease, the landlord covers HVAC, but over $1,000. So what are the scenarios of now I got to replace that and it costs you thousands of dollars? And this example is 15,000. So when you look at it from a net yield, obviously they're still on this 12-year lease agreement, and you have to now do a capital expenditure to replace this. It drops your overall return lower. In this case, it's 5.5% return. So I always want to look at it because, again, I don't want to always discount double nets or ground leases or this type of structure, because there's always opportunities everywhere. But it just comes down to your comfort level, and your level of your career and your investment career, to see if this is something that you want to take on. So, because in essence, if you do maybe a HVAC, they go through and they say, okay, this tenant invested into the building, maybe lease agreement time, you can negotiate a longer term lease agreement and resell it, or you just have another continuous lease agreement that you and the tenant are happy with. So we want to look at every case, not throw out anything, and just look at it from a deal by deal perspective and see what ultimately makes sense for you. So again, why does this matter? So again, right now we're seeing a lot of fluctuations in the markets, investors, and again, everybody wants the highest yield. So it really comes down to what is best for you in that particular scenario, and make sure that mixes well. Some investors, they call and they say, I need this. I said, well, net lease is not going to be good for you. Maybe it's better that you buy, a rental property, get into a syndication, or something, or some other asset, or dump your money into Treasury. We want to make sure we explore all those options. But again, as the market moves, you just want to kind of understand your investment strategy, and then we can kind of work around it to see ultimately if this is a good fit, or something else, or you need to wait. That could be a scenario. We have investors that say, hey, I got a property and somebody's offering me money, I can sell it and I can have cash ready in 60 days. I say, nah, you probably wait it out, and then make your move, and then we can see what options are there as well. So so yield is not always a thing. And then again, we always look at it from when you're buying real estate, what are the benefits of buying real estate, or what are the access to benefits? And one of them are the tax benefits. So once you own it, there's a multitude of options, from cost segregation, 1031 exchange, bonus depreciation, that you can take advantage of, that it makes it more worth the while rather than chasing the initial yield. You want to make sure that, hey, I can actually do a cost segregation, front load a lot of my depreciation, and then I have a better, the numbers look very, very favorable. Or you, like I said, plus all of them have, I mean, for the most part, rental increases throughout the lease term. So not only trying to get the best initial lease term going in, but your cash flow is going to be increasing over time. Which 10% is about 2% annually, which is supposed is coincide with inflation. So we make sure that it is escalating over time. And obviously, with more demand in the market, and depending on the time of the period, it can also yield a significant return on the resale if you choose to do that in the future. So again, the overall point of it is that everything coincide with the lease, and obviously the price could be negotiated, but we want to make sure that what we're buying makes sense. All of the stuff is in there that coincide with your expectations, with no surprises, so we're clear eye moving in when we do make that decision. So common pitfalls and how to avoid them. Again, Cap rate is just one part of the picture. And again, the lease structure, because again, if it's double net or some type of capital expenditure that you got to make that can affect your yield, and you want to make sure that we account all of that in accordance to how long you could hold it and what's your overall game plan to do so. So again, always read the lease first, not last. So that's the end of today's educational piece. So I appreciate that. And again, I cover a lot of this, and I don't go, it's 300 pages, 290 something pages of material. So I go really deep into it. But the big bonus is when you start going behind the scenes and just start looking at stuff. And it's kind of raw, it's not as polished as this presentation, but it allows you to kind of go through my mindset of how I review the leases, how all my successful clients gone through leases, and then I'm try to bother my colleagues, the attorneys and lenders, and see if I can grab them for a few minutes and just give their thoughts and pick their brains on how they look at it and bring up the multiple case studies of their clients and what they did, and how did that look into the future and closing the deal. So that's definitely important and adds a lot of value. So again, if you grab a copy, because with how Amazon works, I don't get that contact information. So just shoot me an email and say, hey, I just got the book, just read through it. Put me onto that email list that you send out that goes through, leases and all that back study. And then I've been to so many properties over the years, and then when I'm there, I'm just like at work. But we're going to be more intentional in filming our whole trip, just to make sure you see exactly like, all right, we're in the back of the building. We went to see a client property in the north part of Florida, east of Florida, and they're taking pictures and looking at the parking lot and looking at the roof and looking here and looking here. So you get to see that, and it gives you more of an insight, like, okay, this is what I kind of expect when I send someone out there. And again, for clients that we work with, we also have a program where if you want us to go do due diligence, look for your property, we can do that as well. And again, I just have to cover our flight and all our stuff there to check everything out. So that's what I have. And again, I know we had a couple people jump in and jump off, which is fine. Any questions, just shoot them. More than likely going to be after this call because we're going to be wrapping up pretty soon. Just be active. Ask any questions. I went through our FAQ thing over the years, and I added some more. It's like over 1,200 I have. You would think something seemed to be more straightforward of an investment. It's not like multifamily where you got to look through 300 units and do this and do that. And it's like most of these are triple net lease. There's a ton of questions out there. So that's why we're trying to bring out this value out to the people, get people interacting with us and just kind of seeing what's out there. This is not as the most sexiest investment. It's just you buy it, and if it's a triple net lease, they pay rent and that's it. Most of my clients don't even go to the property. They haven't even been to the property since they owned it. So it's not the sexiest thing. Sexy is always usually pretty solid. So want people just be more aware of that and get some more vision on this investment opportunity. So again, I appreciate everyone jumping on today. Looks like we've went a full stream without any errors. So I appreciate the staff for that. Look forward to the next one. Look out for emails with our upcoming presentations, webinars, and also our cap rate report on Monday. And again, I appreciate it again. Thanks, Quinn. And we'll be chatting with you soon. Take care.